Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time June 2023. So we have lots going on in Milwaukee, a lot of new construction, new developments. You can see here on the lower left on your screen, the couture is finally starting to take shape. Very soon we're going to have another high-rise on the Milwaukee lakefront, but that's not the only big development that's currently going on. That's probably a topic for another video, but today I want to talk about something else. I want to talk about some very popular misconceptions that people have about the Milwaukee real estate market, most importantly about what I call the seller's dilemma, why sellers feel stuck. It's kind of counterintuitive if you consider how hot the market actually is. So we'll talk about this today, what's going on with mortgage rates, some macroeconomic trends, and take a quick outlook on what we can expect in the near future from the Milwaukee market. But before we get there, let's take a quick look, as always, at the latest numbers from the MLS. So here I have the May numbers. If you have been following my market updates, then this is not a surprise. We have entered a phase where the market is very predictable. We are just in a very, very competitive, very hot real estate market, and there's not much changing at the moment from one month to the next. The only thing that's disappointing here is inventory. May is always the month when we have the most new listings. We were a little bit hoping for an influx of inventory, but you see 2,479 units. That's basically flat with last year. And if you compare it to May 2015, I always use May because that's the last neutral market that we had. It wasn't a seller's, not a buyer's market, just neutral market. So 13,000 units. So we're basically short 10,000 units in the marketplace, and that is driving a lot of what's happening here right now. Sold units in May, 1,974. That's down minus 23%. That is a huge number. We should see more 2,700 units sold in a month like May. That is not happening because there is just not enough inventory. If you compare these two numbers, inventory and sold units, you can tell basically everything that's going on the market is selling within the same month. There's a few that are spilling over in the next month because they need 5 weeks for closing or whatever. And a very, very few select one that are not selling because they're either grossly overpriced, that is still happening, or the condition is just terrible, or sometimes a combination of both. But for the most part, everything that is good is selling very quickly. So of course, with that, we are seeing a very fast velocity in the market, 5 days. What I see changing from last year to this year is last year there were a lot of deals that were coming on the market on Friday and then accepted offer. They have multiple offers and they're presenting on Sunday night. That was kind of how it used to be last year. What we're seeing this year is that a lot of sellers are actually going out with this plan, and then they're buckling under the pressure of buyers, and all of a sudden they're accepting an offer already on Saturday or maybe even on Friday night. So buyers are using every trick in the book, and it's become a very technical, a very difficult market to navigate. Also very, very challenging for agents. So that really makes a difference on how you approach this, how you navigate this. In terms of prices, we're up again. 315,000 is not a median. That's up 5,000 from last month. More importantly, we're up 7.88% median over last year. So overall, when we look at the big pictures, year-to-date home sales are down 26.2%. So this year we have sold in the Greater Milwaukee Area about 2,546 fewer homes, 2,500 homes that are missing from the marketplace. And of course, that is not helping because we really need inventory. In order to better understand what's going on in the real estate market, let's take a quick look at some macroeconomics that are kind of surrounding our real estate world and influencing what's going on in here. And the job market is, of course, a very important indicator. Always pay attention to that, because if there's clouds on the horizon in the job market, that doesn't mean anything good for the real estate market. So this chart here gives you both unemployment rate for the US as a total, that's the blue line, and then unemployment rate for Wisconsin, which is the red line. Remarkably, Wisconsin has a much stronger job market than the US in total. We're at 2.4% unemployment rate, which is quite frankly unhealthy low. It makes it difficult for companies to grow. And the US is at a total of 3.7. The US has already seen a little bit of a change. If you look to the very right of the chart, you can see here the tiny little uptick. So the market starts to respond to what the Fed is doing. They're trying to increase unemployment in order to cool down the economy. That's one of the factors that they're looking at. Of course, they want to preserve the job market, but they need to cool that down a little bit. But companies are really hoarding workers, so they're reluctant in laying off, even as things are cooling down a little bit. They don't want to lay people off. Anyways, point B here is Wisconsin is in really good shape. We haven't seen the change in direction yet, and we continue to have a very, very strong labor market. The next thing I want to take a look at is consumer purchasing power. So you have a very interesting chart here, and let me walk you through this. So there's two lines. The blue line, you're familiar with this. This is inflation. We have seen it over the last 3 years run up to a very, very unhealthy 9% consumer price index. And that's came down now very nicely. We're at 4%. The Fed would like to get down ideally to 2 to 3%. We're still ways away from that. They still have to, keep stepping on the brake to get us there. But what's interesting here is the orange line is giving you wages, and that's also a percentage increase. So you have the axis in percent on the left side. So we're a little bit over 4% in wage increase. Last year we were around 5% wage increase. So maybe you have to talk to your boss about that. But 4%, a little over 4% is currently where we're at. And with inflation, consumers have lost a lot of purchase power over the last 2 years. And in order to get caught up with that, we need now to keep the orange line above the blue line, meaning that the wage increases people are seeing every year, that needs to be more than what inflation is. This way, consumers are getting back some of the purchasing power. So this is kind of sort of moving in the right direction. It's too early to really say, but we have to keep an eye on this and see what is going on with inflation and also with wage growth, which is very much what we need. Next thing here, I have mortgages. 30-year fixed is creeping up again to 7%. So 6.71 here is in theory what you can have here on a 30-year fixed. If your credit and your debt to income ratio is not, 100% perfect, then you're easily looking at 7.5% financing rate. That's currently what we're seeing. And of course, that gets us here into the red area of the market. So anything that is over 6% mortgage rate, the marketplace is perceiving as very, very high, and people are withdrawing from the market. Interestingly enough, the Milwaukee market is not feeling much of that. So even with the higher mortgage rates, we still have so much pressure from the buyer side on too little inventory, and that's what's happening. So 6% is kind of the dividing line. If rates were to fall below 6%, if they're going back into the 5-point-some territory, we're going to see an influx of a lot more buyers that are currently on the sidelines because of the higher mortgage rates. They're coming back into the market. So mortgage rates are very, very important to keep an eye on. No good news from the inventory point of view. Milwaukee continues to experience an absolute listing shortage. This chart shows you the blue line is total active inventory. That's everything that's on the market. The green line shows you new inventory. That is what's coming on the market in this month, in this moment. And you can see Greenlight hit absolute rock bottom here in December. We were kind of hoping that new inventory would start pulling away here and add overall inventory here in the spring market. But as you can see, that obviously didn't happen. So the total inventory and Greenline are moving in unison, which is telling you that everything that comes on the market basically gets sold right away. There's no buildup of inventory. And we would need to see a little bit of a buildup of inventory before we have any hopes of seeing the level of competitiveness coming down in the market. Also noteworthy, both lines are significantly lower than they were 12 months ago. So no good news from the inventory point of view. And that really makes you wonder, why are people not selling the houses? The market is so hot. It should be a great time to put your house on the market. You get so much more money than what you paid for a few years. And so Realtor.com did a survey of 3,000 would-be sellers. And here are the 4 answers that they basically got. People said there's so little inventory that if we sell a house, we're worried we're going to be homeless. Where we're going to go. Inflation is also not helping because that stripped people of a lot of purchase power. If you spend more on gas and groceries, then you have less for a down payment and for your mortgage payment. And combine that with the higher mortgage rates, of course, that is not very helpful. And there's also economic uncertainty. We're still on track for slipping into some kind of a recession towards the end of the year. And this is kind of in a nutshell what leads us into what I call the seller's dilemma. People are saying, I can't put my house on the market in Milwaukee because where am I going to go? What am I going to do? So we have low inventory that gives them fewer choices where they say, okay, there is not much to choose from. I'm really worried that I don't have a place to go. At the same time, prices are going up. Mortgage rates are substantially higher than they were a few years ago. We'll talk about that in a second. And so basically they draw the conclusion they're not selling. And of course, if they're not selling, that means there is low inventory on the market. So this is a vicious cycle, and it's kind of a self-fulfilling mechanism, self-fulfilling prophecy. Because there's low inventory, there is no addition of new inventory. So the reason why I call this a dilemma and not a problem is because a dilemma is something that no matter what choice you take, none of them leads you to a desirable outcome. So if you put your house on the market right now, many homeowners perceive that as a risk that they will not have a house to move to. If they are waiting for later, that could mean that mortgage rates are coming lower, which means prices are higher. So that's not a good scenario either, because you still are a buyer in the market, and then you're facing an even more competitive market. So this is what the definition is of a dilemma. And you can actually turn a dilemma into a problem. A problem is different than a dilemma, because a problem is something that you can work on, and then there is a solution to a problem. So for example, how can I buy and sell at the same time? A lot of people don't know this, but we have found really good ways with our sellers to get a house on the market, get it sold, get it under contract, and then allow them to stay in the house for a month, for 2 months, and go in the market and find another house for them where they can actually move to. So there are a lot of good ways how to approach this and how to do this. A lot of people are also surprised with how much their home is worth. They're looking on the buying side and see that homes are so much more expensive now than they used to be, but they don't realize that they're also getting a lot more money, and they're sitting on quite a chunk of equity if they would put their house on the market. So if you have questions about how much equity do I have, should I put the house on the market the way it is? Do I need to spend money on upgrading it? Is it worth it? We can help with that. I can tell you your house is worth this much as is, and it would cost you this much to remodel it, and then you get a different price, and then you have all the data that you need to make an informed decision and say, is that even worth it? Should you make repairs or upgrades? Also, can you represent me as a buyer? I do a ton of buyer's representation, so if any of these questions is something that resonates with you, then don't hesitate. Reach out to me. A lot of people are doing this. They're sending me an email after they've seen one of my videos. I had recently somebody telling me, well, you must be super busy. You're all over the internet. I love hearing from you. I assure you, I still have time for you. You can go on my website. You have the contact here on the left side, and you can actually see my calendar and see where I still have open appointments, and you can book a Zoom call with me if you like, or otherwise, like I said, just send me an email. If you prefer, you can also just call me. You got my cell phone number here. Text me under this number. Just don't be surprised if I actually pick up, because that's what I do. So with that, I'm the sponsor of this video, and don't hesitate to reach out to me. Let's get back to what's going on in the market. So we have what is currently a situation where we say sellers are rate locked. So this chart is showing you the existing home mortgages in the US and the rates that people have. A lot of homeowners refinanced, took advantage of the opportunity a few years ago, and they refinanced. They might be down on a mortgage less than 3%. Or if they didn't time it well, then at least they're 3.5%, under 4%. You can go all the way up and include this here to under 5%. But for this group, which is the majority of the current mortgage holders, it is not attractive to sell their house and get a new mortgage for a new house, because they would be looking at such a big difference in mortgage rate. And that is what we called sellers are rate locked, because that is not an attractive scenario to them. So let's take a look at what's going on. Why are rates as high as they currently are? And you may have seen this chart before, but I just wanted to quickly refresh your memory. So mortgage rates have nothing to do with the Fed's fund rate. That is something completely different. Mortgage rates are set by the bond market, And when you look over the last 50 years, you can see that the green line, which is the fixed rate 30-year mortgage, is kind of following almost to a T the 10-year Treasury yield. So if the Treasury yield goes up, then mortgage rates go up as well. And there is a typical spread, a gap between them, and that is 1.72. That's kind of the average over the last 50 years. But it usually does not, it can go over that average, but it usually doesn't stay there very long. So at the moment we have a spread of 3.23. So the market is putting a lot of risk premium on mortgages because of the economic uncertainty. And this is the reason why mortgage rates are so much higher than you would actually anticipate it. So there is an extra premium of about 1.51. So if mortgage rates at the moment would be 1.51 percentage points lower, we would see an even more competitive market. People would have more purchase power. It would result in a lower monthly payment, and that would of course drive up prices even more. The reason why I think this chart is interesting because it dates back into the 1970s. And you can see there have been periods when that spread has gone up from the average 1.72 to the 3% line, but it never remained very long, except maybe you might say in the 1980s, but that was a totally different situation with mortgage rates in the 15, 16, 17% range. Nobody knows how long this is going to be, but when you look at this, you understand very easily that there's a reasonable expectation that this should come down relatively soon. And if we don't have that premium, that risk premium over the 10-year yield anymore, then mortgage rates are going to be lower. And this is basically what the Mortgage Banker Association is saying. So they put out a forecast every quarter, and they are predicting that rates are going to go down in the second half of the year. Now, the thing is, nobody knows if that is actually going to happen. You can call that a reasonable expectations, but nobody knows for sure. It's the future. It hasn't happened yet. But one thing that I can tell you, and I've detailed it out here on the left side, if rates are going up and you're buying a house now and you're financially comfortable with your current mortgage payment, you're lucky because rates are going up and you have locked in at a lower rate. If rates are going sideways, well, then you just wait. You've not gained, not lost anything. But if rates are actually going down, which is what a lot of people are waiting for, you just refinance. When you own a house and the rates are coming down, a full percentage point usually is worth it to consider a refinance. You just go to the bank, you have no stress, you have all the time in the world, you can just very relaxed refinance this. One of the things I always tell my clients is never make financial decisions based on your emotions. I see this happening all the time, so I really stress this. When you're trying to make a financial decision, put your emotions aside, take a calculator, an Excel spreadsheet, whatever works for you, but base your decision on math. So if you want to buy a house right now and you just feel that it's the wrong time because mortgage rates are so high, then do some math. You might come to the conclusion that the higher mortgage payment at the moment on a typical Milwaukee property will cost you, let's say, $300 more a month. If you can comfortably afford that, do the math and say, okay, 12 months of this is $3,600. That's the cost of doing this now, with the assumption that rates are going to be lower, which means that you can refinance, but that also means more competitiveness in the market, probably higher prices in the market. So if the market moves on 5% or 10%, what does that mean for that property? Is that another $20,000, another $30,000 that you will have to pay more for a listing? So use math to make those decisions. You have to be the judge of this. Use your own assumptions. I'm just laying it out for you, but use math and don't make these decisions based on your feelings. I launched a quick survey because I wanted to see what my audience is actually thinking. So this is a survey that I did on YouTube, and I asked my subscribers, will Milwaukee home prices over the next 12 months, in your opinion, go down? 15% said yes, remain about the same as now, 38%, and go up, which was 48%. So my take on what's going to happen next here in the market is that the summer market is going to remain very hot. There is no indication that this is going to change over the next few months. Usually in July and August with vacation seasoning, so that takes off a little bit of the edge because some people are traveling, so that takes players out of the marketplace. We will see if that has a measurable impact this year on the market, it doesn't really look like that, but generally this is what we would expect from the season, and then it usually picks up again around back to school time. Spring comps really set the baseline now, so there's no issues with appraisals. I spoke with the banker who does a lot of volume, and they said we looked at our data and we only had a little shy of 5% of all appraisals come back with a low value. So about 95% confirmed the value. In terms of inventory, I'm not anticipating much change. There's not an influx of inventory on the horizon that could hit us in the next few months. So we're probably going to stay in the 2,300 to 2,500 unit per month range you can choose from, but they are going to go quickly, just as we've seen it in the past few months. The only real wild card that is out there would be a change in mortgage interest rates, and we're going to continue to keep an eye on that. That is pretty much all I had for you today. If you got value out of this video, please give it a thumbs up. That would mean a lot to me. And with that, thank you very much for watching, and I'll see you at the next one.